joined. My name is Yash Sankpal. I am the REIT analyst here at Laurentian Bank. And before we start, some housekeeping items. Please ensure that your microphone is on mute and your camera is turned off. Also, please make sure that your name appears on the screen so we can properly address any questions you may have. We request that you hold your questions until the presentation is over or the discussion is over. You will get time at the end to ask questions. Please use the raise a hand feature if you have any questions. If you experience any technical issues when it is your turn to speak, please communicate that through the chat. If you would like to download the corporate presentations and biographies, you can access them from your virtual briefcase during and after the presentation. You can also explore more information using the icons on the bottom right of your screen. With that out of the way, we are now moving to the main part of the meeting. In this panel, we're going to chat with the CEOs of 3 commercial REITs, and we're going to ask them how they are handling the pandemic and what their game plan is going forward. First, let me introduce our guest panelists. With us today are Mr. Jason Parravano, CEO of Fronsac REIT, Mr. Jim Beckerleg, CEO of Pro REIT, and Mr. Michel Leonard, CEO of BTB REIT. Michel is yet to join us, but we're going to start off. I'm going to start by asking each of the panelists to give us a 2-minute intro of their company. Jason, why don't you start?
Thanks, Yash, and thanks for having us here today. I'm the president and CEO of Fronsac Real Estate Investment Trust, and the whole premise of the Fronsac model is to own, acquire, and develop management-free properties. So we take the net lease space and go a little bit to the next level in the sense that our properties are self-managed by our tenants, which allows us to concentrate on growing our business as opposed to running our business. The Fronsac story is a relatively new one. I've been with the company now since 2015, and we've experienced some exponential growth since then, growing from 10 properties back when I joined to somewhere around, we'll be around 85 properties within the next quarter or two, across 3 provinces, Quebec, Ontario, Nova Scotia, going from 15 million in assets to close to 250 million in assets within the next couple of quarters. The focus has been finding these types of properties and growing the trust with a focus on per unit cash flow and per unit FFO. And we've grown our distributions now 140% over the last 9 years. We've kept a conservative payout ratio in the 50s and grown our per unit FFO by 274% over the last 9 years. So that's the overlay of the Fronsac world, and I'll pass the mic over to Jim.
Great, thanks, Jason. Thanks, Yash. Good morning, everybody who's listening. So Pro REIT, also a relatively young REIT. We were established in 2013, really. Started our significant growth in 2014. We're a diversified commercial REIT involved in retail, industrial, and office properties across the country, although the focus of our operations has become Manitoba east to the Maritime provinces. We have today about $635 million of assets, and will be growing substantially in this first quarter of 2021. That is comprised of about 4.5 million square feet of commercial space. And we are about half of our property revenues are now from the industrial and commercial mixed use sector, about 30% from our retail, which is needs-based in secondary or strong B markets in the eastern parts of the country, and the balance in specialized office exposure. We see ourselves continuing as a diversified REIT. although we focus our efforts and current strategies, growth strategies on where we see potential upside or better upside on leasing maturities and that type of thing. And so right now we have been expanding in the industrial and commercial mixed use sector. We've announced about $100 million of in-process acquisitions in this quarter, and we see further opportunities as the year goes forward. So that's PROREIT.
Yeah. Okay. Michel had just joined us. Michel, do you need a minute to get set up?
No, I'm okay. Can you hear me?
Yeah, we can. I can hear you clearly.
Perfect. Thank you.
So,
Sorry,
Michel,
I had difficulty connecting. My ID number had expired, and so anyway, yeah. Now I'm here.
okay. So, Michel, we're just starting off. So maybe you could give us a 2-minute intro of your company, and after that, then we'll go into particular questions.
Okay, perfect. So BTB is a diversified REIT. Our occupancy rate at Q4 2020 was at 92, a little bit more than 92%. Our total debt ratio was at 59%. And in Q4 2020, we had collected 100% of our rent. The only month where we have the difficulty collecting was in the month of April of last year. And our average rent collection for 2020 stood at 99%. We generated at Q4 an FFO per unit of 9.9 cents. In 2020, we had 1.1 million feet of lease renewals and new lease transactions, of which 280,000 square feet were new leases concluded during the year, showing in reality the fact that our portfolio is robust even during the pandemic. And if we look at all the lease renewals that we did conclude for 2020, we saw an increase of 6.8% in our lease renewal rates. We're diversified and mostly located in 3 cities, the city of Montreal, Quebec City, and Ottawa. And as being diversified, we own retail properties. We don't own enclosed malls. So it's destination and necessity-based retail operations. And I believe that the diversification of our portfolio really showed the robustness of our revenues as a result of having not only retail properties, but having the office properties and the industrial properties contributing to our great rent collection. So based on this and based on the leasing activity that we did generate in 2020, we're very bullish on the prospects and the future of BTB.
Okay, thank you, Michel. Okay, so now I'm going to ask a general questions to all of you. Given what we have seen over the last 1 year, I just want to understand how the pandemic has changed your view about your business, and what changes are you making based on the lessons learned so far, how you are positioning yourself for the rest of 2021. So I'm going to start with Jason.
Sure. So the Fronsac business was, I would call it immaterially affected by the pandemic, just because of the mix of our asset base: convenience stores, grocery stores, pharmacies, banks, Dollarama, quick service restaurants. So, even at the height of the pandemic, approximately 97% of our GLA remained open. And more so, looking at our tenant mix, they were the only ones open, and the rest of their competition was closed. So if you look at the quick service restaurants, most of or almost all of our properties have drive-throughs, the grocery stores. So for the most part, our tenants were actually experiencing year over year increased sales as a result of the COVID-19 pandemic. So that being said, that kind of shows the resilience of our portfolio and its ability to make it through, one of the toughest times in our existence. That being said, Looking forward, we plan to do much of the same, target the same type of properties for acquisitions, and continue to work with our tenants who are developing to create another source of pipeline of development properties. So no real changes going forward, just more of the same for us.
Okay, Michel?
I don't differ. My answer is not going to be different than Jason's answer to your question. I think that there is obviously in the market, in the diversified REIT environment, there's a big play right now for industrial properties. And industrial properties are getting very difficult to acquire and very expensive and difficult to justify given our cost of capital. So for sure, we're looking at acquiring industrial properties if we can, and if it is accretive to us. And so yes, on that front. Retail properties, we own the destination-based shopping centers that are well located within our 3 core markets, and most of them, as the enclosing as the government decree reopened certain stores, then our stores were reopened quite fast. And we had necessity-based, whether they were Walmarts of this world or the Provigos, Loblaws, and food stores, where they remained open, as well as the pharmacies that are core to our retail investment. As far as our office property, we didn't see a lot we saw the resilience of our tenants. We're mainly located in suburban environments, so we don't have the problems that come with high-rise towers where people, if they want to reach their office space and they're located on the 41st floor of an office building, it could take up to 2 hours in order to reach that floor, given the capacity of the elevators. But we don't have this type of investment. I think that our tallest property is probably 6 floors, 6 stories high. And so our tenants have been paying well as well. So it doesn't deter us from continuing on our investment in suburban office properties, nor industrial properties, and nor as well the investments in retail.
Okay, Jim, has the pandemic changed your view about your business, and how are you positioning yourself for the rest of 2021?
Yeah, so Yash, you're not going to find a lot of difference in my response from my 2 co-friends. So our portfolio being diversified, being focused outside of the downtown cores of the major cities, went through the pandemic. I'm pleased to say, and I'm fortunate for ourselves and our unit holders, relatively unscathed. We are back to collecting essentially 100% of our rents, and had only very minor participation in the federal government programs. We did some abatement and deferral programs with individual tenants in some of the smaller centers, but those have all now matured, and any repayment conditions that we had set have been met. I think, again, similar to my co-friends, I think that the strength of being a diversified REIT has been shown by the pandemic, in that you don't have exposure to specific areas that can have a very large and sharp impact on your operating results, but rather things are diversified across geography, real estate sector, and so on. So we actually, again, similar to what Michel just said, have found it, and Jason's found that many of our tenants have prospered during the pandemic, and as their leases are maturing, are looking for expanded space, and we're able to get improving rents, especially in the industrial and commercial mixed-use sectors of our portfolio. Going forward into 2021, how has the pandemic changed our business? I guess we're a little less focused on office acquisitions right now. I mean, we're comfortable with what we have. Again, similar to some of my co-friends here, our exposure is in suburban areas of the cities that we're involved in, and have not seen the same impact as the downtown cores. But we do see the office sector is probably going to need a little bit of time to work out as we come out of the pandemic, just to see how it does affect the future of office work and some of the tenancy. So we are focused on really on the industrial and commercial mixed use sectors. I agree with what Michel said earlier, that opportunities are becoming tough and prices are increasing, but we do think that there is a lot of turnover of properties, because last year was a very quiet year. We've done a little over 100 million in that sector in the first quarter of this year, and we actually see further opportunities. So I think when you can get into that growing sector of the market, we're still investing at significantly below replacement costs, and in many markets below market rents. There is going to be continued accretive opportunities for us. So as far as our retail is concerned, again, we're also not in covered malls, and we're in needs-based, community-based strips. Those have prospered. We have not had any significant vacancies. We renewed 97% of all of our lease maturities last year. We've already done over 78% of 2022 maturities. But we don't see quite the same growth in even the strong retail properties that we're seeing in some of the other sectors. So that's where we're focused right now.
Okay, thank you for that, Jim. Now this question is like for anyone who wants to answer it. Are there any new levers of value creation that you discovered during the pandemic and the way you are operating in a restricted environment?
I'll be first to answer that one. And I wouldn't really call it value creation, more in the sense that what we've seen now, especially in our space, in the retail spaces, we finally have divided the retail category into two distinct groups, where you had the traditional retail, the strip, the plaza, the enclosed mall. And now we're using the new coin term, call it essential retail. And be it the grocery anchored, pharmacy anchored property or single tenant property. And there's a lot of private capital in the system right now. That being said, investors are chasing security, safe investments. So in terms of value creation, what I've seen actually is a lot of cap rate compression right now in this space, like we've seen the cap rate compression happen in the industrial space over the last few years. But when you're looking at the private capital, so the small ticket items, call it anywhere between the $1 to $5 million property, we're seeing investors not really care about the cap rate and just deploy capital in these investments, which is compress the cap rates to sub 5%, sub 6%, sub 4% even, just because they need to chase the safety, they need to deploy the capital. They don't like putting it in the bank because the bank's not paying them any return on their money. So that kind of cap rate compression has created a lot of value when you look at balance sheets, in this kind of distinct retail sector.
I think, if I may, I see the same as Jason has mentioned. It used to be that our biggest competition in the retail landscape, in the necessity base, was basically larger groups, and now especially when the brokers are putting on the market, let's say a Shoppers Drug Mart outlet, all of a sudden everybody comes out of the woodwork and the bids are extreme on these properties. So overall, when we target certain investments, the different bidders for the properties are from every environment, and the people are looking for safety or safe investments, and they're ready to pay certain cap rates that we at BTB cannot afford because we want our acquisitions to be accretive. And I would add to what Jason said that now the brokers are marketing the different products as COVID proof. So that's the new term that's been used. So we see, and I don't know how legal it is to call something COVID proof, but it is an eye-catching aspect to the business. So anything that is necessity-based is now called COVID-proof, and overall it attracts a lot of interest for these COVID-proof type of.
Maybe just as an expansion of what Michel's saying there, I think what the market is starting to realize is, well, we've always talked about industrial, retail, and office REITs. Each of those real estate sectors really have very important subcategories. And so in the industrial sector, the great Amazon logistics, warehousing, and delivery points is really not the same real estate as your multi-bay small industrial buildings that are servicing an important part of the economy, but they're just, again, different sectors. And the same thing is in retail, I think, and certainly all of us are trying to emphasize, but community strip malls that are delivering essential services to their communities are a very different type of real estate than the huge covered malls. And we continue that into the downtown, the suburban office versus the downtown office. So a lot of the very large real estate requires much greater commitments of capital for maintenance over time, and tend to be more highly levered from an operating and taxable point. And so I think investors are starting to realize the opportunities in these various subcategories and to follow them. But Michel and Jason are certainly right that there is an enormous amounts of liquidity still in the system, and the broad investment market still sees, probably on an increasing basis, that real estate is attractive. And so we are competing to an ever greater extent against private equity funds, whether that be smaller family savings, things like Jason was speaking about, or whether you're dealing with very large international private equity groups competing in for large properties.
All right. Now I want to talk a little bit about your specific company. I have this slide in front of you, which shows, FFO per unit, historical FFO per unit growth of various diversified REITs and retail REITs. I just want you to tell our investors what happened so far in terms of FFO per unit growth and what you want to do going forward for your company. So
I can start that, Yash, to say that so when you're dealing with a new REIT, we only have a handful of years under our belt. We had some pillars that we wanted to deliver for our unit holders, which didn't always include just ensuring the highest possible growth on a quarter-over-quarter basis. And that included our diversification strategies across a great variety of measurements. So not only over the traditional real estate sectors and geographies that we have talked about, but also over covenants, quality of covenants, length of lease terms, and that type of thing. We have, and scale has been important to us. We've believed that part of the diversification that our unit holders would like to see, because it provided stability to the cash flows of the company and therefore the monthly payouts. Scale is an important objective to ensure you got into place in the early part of your growth. And then I think the third thing is on the debt side. So we have what we might not have foreseen 5 years ago, is we've had opportunities on 2 or 3 occasions to substantially extend the term of our debt at these very low interest rates out towards 7 to 10 years on renewals and new acquisition financings, which perhaps cost quarter-over-quarter accretion compared to if we'd put traditional 3 to 5 year debt on these properties. But we think that's provided greater long-term value for our unit holders, and will continue to do so. I think that the pause that we all saw in 2020 in our expansions will provide investors an opportunity to see the quality of the FFO more closely on a quarter-by-quarter basis going forward. Although, again, sometimes as companies are expanding quickly, FFO gets diluted and AFFO in the short term because you have funds on your balance sheet which are waiting to be deployed at your next stage, your next opportunity stage.
If I may, for us, when you look at the overall performance, it's been affected by the fact that 4 years ago, our total debt ratio was at 72%. And we had consciously decided to reduce our total debt ratio. So it went from 72% to, at the close of last year, at 59%. And given our certain activities in the market, it's still going down. I'll give you an example. We issued debentures in September of last year in order to replace a debenture that was coming to maturity. And the time to go to market in equity, although our intent was to go in equity, the timing was not great given the pandemic. So we did issue the debentures. And we consciously gave it a conversion price that was low. And since the month of December of last year, we started to receive conversion notices. And so far, we've converted about 10% of the $30 million debenture. So as this debenture is going to convert it to equity, it's not really accretive, but it's going to further reduce our debt ratio by roughly 3%. So we will go from 59 to 56 if that debenture is completely converted. And this is what we want, and this is what we wanted to achieve. So when you reduce your debt, it has an effect on FFO and AFFO, but you have to be conscious of the fact that to replace debt with equity, it does have this effect, this non-accretive effect. But given the overall scheme of things, for us, it was important to reduce it. And we're very happy to be at the point where we are today, from 72% to 59% to eventually to 56%. And our mortgage debt ratio is very stable at roughly 52%. So this is the element for me that shines and shows that it did affect the AFFO and the FFO.
Okay, Jason?
Yeah, each Jim or Michel obviously have their views on the way they've grown their business or how their business has matured over time. Not saying that there's anything wrong with the way that they're doing things. It's just Fronsac, we've done things a little bit differently. Is we've taken a much more conservative approach as we've grown, whereas scale is not as important to us. For us, it's really been the focus on the per unit growth. We maintain a conservative debt to gross asset ratio in the 50s throughout our growth. We've maintained a lower payout ratio in the 50s since our inception. Our yield might not be as attractive to our peers, but what we've been able to do over time is convince people to invest with Fronsac, because of the per unit accretion, and kind of put the if you want to call it yield aside for a little bit. That's been our approach. That's how we've been able to go out and raise capital. It might not be as sexy, right? I'm not going to say that I guess scale obviously is a beautiful thing, right? It's easier to attract more investors when you have scale. It's easier to attract bigger checks when you have scale, and it's obviously easier to grow when you're chasing $100 million, $200 million portfolios. We've been doing the ones and twos, which has allowed us to translate top line revenue into bottom line FFO quicker. We have an extremely lean overhead. At the end of the day, because of the way our business is built, because of the management free approach, this business does not require 50 employees, right? We have call it 80 properties with an overhead below $1 million a year, right? So that allows us, like I said, to convert that top line revenue into FFO faster. For us, it's always been about finding the opportunity first and then the capital. So over the years, we've never raised capital that we didn't have a source for. So that being said, the last two deals, we raised $35 million worth of equity in 2020, and we deployed it into about $70, $80 million worth of acquisitions. But it's always been about finding the opportunity first and the capital after. What that allowed us to do is not to have dormant money sleeping on the balance sheet. And as my peers know, cash in your pockets burns a hole in your pocket, especially when you're paying a distribution. So we've always been good at finding the opportunity, raising the capital, and deploying the capital quickly. We completed a $17 million equity issuance and $6 million debenture issuance back in November 2020. I think we closed the equity issuance on November 26th, and on December 1st, we acquired $45 million worth of properties off of Choice REIT that is added to our kind of essential needs-based asset base. But for us, it's always been about, if we have to scale back and not grow as quick on a total asset on an aggregate base, we're okay with that, because the focus really has been on the per unit FFO accretion.
Okay, thank you for that, Jason. Now, the next question is a general question, and it is not to an executive, but it is to a real estate investor, and who is looking at the broader market and thinking about it. So I want to understand how you look at the world when you look at the retail sector and the office sector. I just want to understand your general view. It has nothing to do with what is in your portfolio, just how you think about the real estate sector in general, and those two subsectors.
If you, Yash, I can go first. In September 11, 2001, New York City was attacked, and 2 World Trade Towers fell. At that time, people said that nobody is ever going to lease office space in Manhattan, and people said that certainly nobody would want to reside in downtown New York. And people started to move out of the downtown and take spaces in the suburb. At the time, the owner of the World Trade Center, I think he had acquired the building 6 months prior, and people were saying, this guy's gonna go bankrupt, he's never gonna be able to find tenants for his property, and so on. A few years later, they built a taller building than what stood in its place, and the tenants came back, they leased space. The tenants, the tenants leasing space and leasing apartments came back. Condos, the market for condos came back in New York, and as a result of it, it was one of the tightest markets: office market, apartment market, condo market, and we saw stars selling their condos for $100 million. So the sentiment at a time, at a crucial time, a difficult time, is always very, very negative. And it's as if we lose sight of what existed and what will exist. And we're in the midst of this. So our judgment is affected by the fact that we know that the banks, the stockbrokers are not occupying their downtowns. And in the downtown, the problem it is present in downtown Toronto, downtown Montreal, Vancouver, New York, etc. And as we're going to come out of the pandemic, because we see the end of the tunnel through vaccination, to herd immunity and all this, we see that we're going to come out of it. And the first reactions that we get out of this, and if you speak to your buddies and if you speak to your family, people want to travel because we've been confined. And so people say that the travel industry is dead. Don't invest your money in the cruise business because they're all going to go bankrupt. And all of a sudden, if you've been vaccinated, if your destination is secure, I think people are just going to go for it in a big way. And it's going to be the same thing for office space. Office space today, people say, it's a difficult proposition. In our suburban environment, as I mentioned earlier, last year during the pandemic, we leased 281,000 square feet in total. Of this, there was 80,000 square feet of office space to new tenants. So it's still there, it's still present. People like the way that we are, the way that we think, the way that we socialize, we need the environment. The big IT companies, whether they're Google, Amazon of this world, where they've like started the process of asking their employees to work from home a few years back, they asked all their employees to come back. And the reason for it is because if people, and I understand that there are systems that allow for Zoom meetings, for collaboration and so on, but there's nothing like being close to a person and having a discussion in order to solve issues, solve problems, and get on with it. So there's right now there's a lot of frustrations with employees that are working from home, and especially women. And this is a little bit of a disaster, because with the schools, with the role of women at home, and I'm not being facetious in any way, they've basically increased their burden twofold, threefold, fivefold, because now the husband is home, so they have to prepare breakfast, they have to do the sandwich at lunch, and they have to prepare dinner. The kids are at home, so they have to take care of the kids. And then there's still demands from work where they have to perform at work. So how they do it, I don't know, but somehow, somewhere, women are not going to want to work from home when this pandemic issue is out, because for them, they're going to be liberated. So, and they have, they have handled this huge burden throughout this process. And I think it has to be recognized, because the guys, they went to work, or the guys, they don't really have contributed to whatever, the home front requirements were. So in my mind, it's easy to say today, and I'm summarizing, it's easy to say today that, the office sector, especially the downtown, because we don't see this in the suburbs, especially the downtown, yes, the downtown is dead. The president of National Bank, Louis Vachon, said to his employees, they're building a new tower in downtown Montreal, and he said, you're all coming back to work. So I think that we're going to quickly forget the impacts on us of the COVID, and we are going to get back to work in our office environment with a few changes. It may mean that we're going to work from home a day, 2 days a week, if need be, whatever. And I think employers are going to allow that, but that's not going to change the need for office space. Is the office space going to shrink? I really doubt it. I think that the proximity, think about call centers, whether for large telecom company or whatever, the proximity that they had to work together. I think that the spaces are going to, I think that they're going to take more space than before, because of the proximity and because of whatever is going to pan out of the virus in its new stages eventually. So I'm a strong believer in the office space environment. I think that right now, I'm not wearing rose-colored glasses. I know that it's going to take time. I know that the tunnel, we see the end. We don't know exactly when the end is, but we see the light at the end. But we know that we're in due course, we're coming out of it. So that's my take on it.
To be just a little bit controversial for our discussion purposes here, I certainly agree with Michel that over the long term, real estate is going to return to its former vigor in all sectors. I mean, real estate is by far the largest user of capital in the world. I mean, vaster than the bond market, multiple times in stock markets of the world. And so it will always continue to attract capital and will prosper over the long term. But when we're looking at acquisitions right now, you asked about the retail and the office sector. I guess retail, we have been and will continue to look at strong anchors in our community strip, because it's the community anchors that we believe in hold the value of the property and attract the smaller tenants to come in and surround them and provide services to the community. So I think going forward, we think the anchor nature of any retail strips we get remains of paramount importance. On the office sector, I generally agree with Michel. We continue to actively renew our our maturing office tenants in the suburban markets last year, but things can, over the medium term, and that's the long term in running a REIT, go bad in urban office markets. So we can look at the history of mainly US cities when you go, but you can look at what's happened in Denver, what's happened in Houston, what's happening in Calgary right now. And I believe that could be the kind of thing that's going to happen in Toronto and Montreal, meaning it's going to take much longer for stability to return and confidence in some of these towers. Not to say that they can't be traded, but I don't think it's, I agree with Michel that there's societal pressures to bring people back to the office, but I'm not sure it'll be in the same way. And I think we have to give that time to work out. We've always tried to avoid, probably for the same reasons, I mean, central urban office space, because not only does it have the risk components we've been talking about here where people are concentrated, it also has traditionally required a lot of capital or reinvestment on tenant renewals and that type of thing. It's a capital intensive use of your own restricted capital. And that's why it tends to attract only the largest of investors.
And to be even more controversial, Michel, I'm the one that cooks dinner in my house, so my wife has it easy. I agree with my peers. I think that the return to the office is just a question of time. And if you are a private investor looking at either office or retail space and you have to make that decision, well, you know, what we're going to see in the short to medium term in the office space is the volatility, right? There's tons of sublease space available right now in Montreal. I think the number last week was somewhere around the 2 million square foot mark. So if you're a private investor looking to invest in office space right now, probably leave that for the institutional players to do it, just because, you know, the institutionals have more capital and can stomach the volatility. But in the long term, there is definitely a return to the office. In what capacity, it remains to be seen, whether it be on a rotation basis. I do not believe that space requirements are reduced. If anything, they might increase. But definitely a return to the office, because the toughest thing right now is training new employees, right? You need to be around the leadership and kind of learn by osmosis on how to become a leader. That's very, very important. And unfortunately, that does not happen through a Zoom call or a team meeting. You need to be around leadership. So for that reason alone, I believe that the return to the office does happen. And what we're going to see is, you know, over the last year or two, or the next year or two coming as well, a big gap in succession planning, because leadership hasn't been able to develop over the last year, in my opinion. Same thing with the retail. Good retail is always going to be good retail. If, you know, the private investor looking to invest in retail, you know, with people working further and further away from the core now, and having that rotation, and perhaps buying the property a little bit further from the core, you know, not being in the Westmount of this world and being on the North Shore or the South Shore, there could be additional opportunities in retail in secondary markets or more or suburbs of core markets. So that's how I kind of see, you know, the opportunities for someone looking to invest in either the office or the retail is, you know, focus on the secondary if you're going to look at the retail, because you're not going to be able to compete with the institutional players. And if you're into the office thing, take a back seat for the time being and let the institutional players kind of handle the storm or absorb the volatility.
You're on mute.
You're on mute, Yash.
Sorry. Nishita, do we have any questions from the audience?
Yes, there are no questions from the audience as of now.
Okay. So end this session here. I would like to thank the panelists for sharing their views and giving useful tips for our investors. Coming up next is our multi-residential panel at 11 o'clock. In that panel, we'll chat with the executives of BSR REIT, Interrent, and Killam REIT. And we hope you can join us. Thank you very much, panelists. We
Thank
really
you.
appreciate you taking the time.
Thank you.
Yep.
Thank you,
Thank you,
Jason. Thank you, James.
Yeah.
Nice seeing you again.
Congratulations on your deal last night, Michel.
Thank you very much.
Thanks.
Yeah, well done. Thank you.
Yash. Bye-bye.
All right. So was that okay, Nishita?
Yep, we're all fair now.
Yeah, it was okay.
Okay, so